Hi everyone, my name is Mary Redmond. I'm talking right now about the Australian dollar US dollar pair. And so this is going to be a pretty difficult trading week. Actually, it already is. I mean, you've got a holiday on Monday, then you have the non-farm payrolls coming up. Plus, we're kind of at a critical junction in the market. We're coming up on the end of the quantitative easing, but quantitative easing is still going on. It's still putting a cushion of liquidity under the market. And it's also, I think it's a somewhat difficult week for the US dollar. There are a lot of factors contributing to that, but if you look at the dollar index here, the broadest dollar index, well, it doesn't look particularly encouraging for the bulls. It kind of looks like it's had a big move up, a retracement, and now it's just range bound in this particular area. And there are a lot of reasons for that. I think some of it may be due to the incredible bull run we've had in the stock market, and there may be some impact on the dollar due to the politicians' refusal or the delay in increasing the debt limit. That could be putting up some weight on the dollar. And most people think that it's going to happen. I mean, I think it's highly unlikely they would allow the U.S. to actually default, but you can look at looking at the in-trade futures here, which I kind of look to get an idea of what people are thinking at. The probability that Congress is going to approve an increase in the debt ceiling before August 2011 is a 67% chance. So the markets are still assuming that's going to happen, but you also want to consider the fact that 2 weeks ago there was an 85% chance. So the longer the politicians delay and the longer there's infighting, it's going to put some pressure on the dollar, as there is due to other factors. I mean, the last few economic reports we've seen from the U.S. did show a positive sign of growth, but not enough for the Fed to be pushing ahead or moving ahead on any type of interest rate increases. So the two most important factors are the interest rate increases and the interest rate policy from the Fed, as well as the risk appetite and the movements in the stock market. So we haven't really seen a big break either way. I think we're probably going to have to see a few more months of strong employment growth and a few more months of strong economic reports and possibly increasing inflation for the Fed to increase their expectations of interest rates. And you'd also have to see a pretty substantial move down in the stock market to see the dollar go higher. And that's what's really going on right now. We're kind of in a range-bound market with a bias towards the upside. And we did see a break out of the downward channel, the short downward channel in the Dow and the S&P this week. But it's going to take a lot more momentum for the two major indices to clear their their 52-week highs and move higher. And this week, we're probably not going to have enough volume for that to happen. And yesterday's stock market rally came on fairly small, fairly low volume in liquidity. So it does show that it may have been more short covering than actual institutional buying. And you can see that if you go to the Investment Company Institute's website, and I used to do this more looking at mutual funds, there's still a lot of money coming into these stock mutual funds. Stock funds have an inflow of $6.58 billion in April. So a lot of that money that comes into the results from the Fed's quantitative easing is still going into the stock market. But on the other hand, you're going to be coming up on the second half of the year, and during June and the first part of July, you might hear from some companies warning about their earnings coming up. Before you get the earnings, you always get earnings warnings. So the fund managers are probably going to be concerned this point about chasing stocks higher, and that's why I think you're going to get a range-bound market here. So we've also got the volatility index hitting a new low level, and with the Australian dollar, it's a pretty accurate, or not 100% accurate, but when the volatility is high like this, that was a good for the Australian dollar. When the volatility hits these low levels, it might be a pretty decent short depending on other factors. It doesn't mean that the volatility can't go any lower, but I wouldn't want to go long the Australian dollar, US dollar, or the stock market when the volatility is this low. And we also had, since the Australian dollar, US dollar is really a strong proxy for global growth, we've had some measures really all over in the EU, in China, in Australia, and in the US that show that there is some sign of slowing of global growth. It doesn't mean that there's some type of a massive crash in Australia or in China. It just means that the Chinese rate hikes are having some impact, and the incredibly red-hot rate of growth that there was in the Australian dollar in Australia may not be able to continue. And if you look at the Purchasing Managers Index that came out, the EU Purchasing Managers Index showed a slightly slower rate of growth of 54.6%. The Chinese Purchasing Managers Index was slightly below expectations. The Australian GDP growth slowed by 1.2%, and granted, that was a one-time slowing, which most analysts and the Australian government attributed primarily to the problems they had with the floods. And also there was an impact all over the world from the Japanese earthquakes and hurricanes. So they do expect growth in Australia to pick up in the second half of the year, but perhaps not at the same pace that we saw over the last 12 months. So we also saw a slowing in the UK Purchasing Managers Index. And all of these signs are pointing to, some slowing of growth, which is going to make it hard for the Australian dollar to maintain this incredible momentum that it's had. And I think that if you look at what's going on this week, I'm inclined to short it at the 107.50 level. I know it's a fairly risky situation here, but just because there's resistance up here, and I think it's going to be very difficult for the stock market to maintain a very strong rally this week and next week. And I think it's also possible that the markets are going to start pricing in less of a inflationary expectations from the RBA. Of course, they have still, almost all the central banks in the world are concerned about inflation except for the US Fed. That's why the US dollar is low. But on the other hand, with the Chinese raising rates and continuing to raise rates so aggressively, they're kind of doing the work in Australia for the RBA. So that's just a position that I think might be good this week, and I think going into the rest of June, when if the Fed stops the quantitative easing after this round, which is supposed to end June 12th, and going into the summer, I think that we could see a pretty good pullback in the markets. The markets are really overbought, and we probably could see a pretty good pullback in the Australian dollar, US dollar, because the most important factor for that particular pair is the movement of the stock markets and global growth, and we are starting to see the beginnings of that. And of course, there's other, there's factors that are weighing on the dollar right now, and I think the dollar is going to have to, there's going to have to be other indicators that are going to come into play with the US dollar in order for it to be able to sustain a really strong rally. But as far as right now, I think the Australian dollar is overstretched to the upside, and I think around 107.5 is a pretty decent short for this week if you put stops in around 108.